Plant Hunter Guy podcast.
Welcome back to the Plant Hunter Guide podcast. We've got Mark Randall from your finance team here. Mark's our accountant, and a bit more than that too, he's our advisor. Mark, tell us a bit more about yourself.
Firstly, thanks for having me today, guys. Great to be back at Architectural Plants. I'm Mark Randall. I run a company called Your Finance Team. So we are a firm of bookkeepers and accountants. Primarily what we do is outsource finance services for small businesses like architectural plants. So my background, I've worked in finance and accounting for all my professional life. So I did a finance degree. I qualified as a chartered management accountant in my 20s. And then I went into corporate accounting. So I did big corporates. I did FTSE 30 companies. And then I did some private equity work for private equity backed companies. And then 10 years ago, I made the step out of corporate and I set up Your Finance Team, really with the ambition to support small businesses and bring that sort of big company accounting feel to small businesses. So that happened 10 years ago. And Architectural Plants were one of our first clients. And I'm pleased to say, we're still going strong 10 years later. We built a great relationship with you guys, get on really well. And that's what we're looking to do. We're looking to build deep trust with our clients.
Yeah, it's brilliant because we, at the time, were using Xero we just started using it.
Yeah.
And there weren't many people that knew about it. So we did a quick Google and your name popped up because you, as a Xero sort of specialist. So for us, that was an amazing, also brilliant marketing that we found you straight away through that. And we haven't looked back since, have we? We've done so much together. So why did you choose Xero? What was the link up there?
Well, just to explain what it is. So Xero is an accounting piece of software. It's quite common now, it's quite mainstream. 10 years ago when we first started using it, it wasn't so mainstream. And the reason why we use it is because it's more of a business tool rather than just a pure accounting tool. In the old days, you had to be an accountant or a bookkeeper to understand how these systems work. Where Xero came in, it was like a breath of fresh air because actually the language was just really simple, money in, money out. So we were one of the early adopters of Xero, and therefore we were looking for clients that also wanted to use it as well. And we look at it very much now as a business tool as opposed to an accounting tool. So it's therefore business owners can use it not as an accounting system. Yes, it is an accounting system, but more of a business tool. It's what you can get out of it, where the value is being added, in my view, as opposed to just a pure accounting system, which is just debits and credits and what have you.
100% agree. And we saw that 10 years ago when we sort of took it on, because we didn't want to see it as just an accounting. We wanted to see the reporting, and it's got much better now, hasn't it?
There's an evolution over those 10 years. And the other thing that's happened as well in that whole sort of digital accounting space is a whole myriad of apps now, applications that you can bolt on to Xero that do all manner of things. So, reporting, timesheets, debt collection, you name it, it will be out there. And actually part of the challenge that we've got as accountants is to work out what the best solution is for clients now, because there is quite a lot of choice out there. We've got to distill it down and say, actually, based on what we know, these are the tools that would support you.
Yeah, that's a bit of a thing generally with tech, isn't it? I'm finding that the more tech there is, it's great, but you've got to be really fine-tuned on knowing which ones to pick for different areas, whether it's accounting or customer management or whatever it is. You've got to be really sort of quite defined in that.
Exactly, and really it comes down to how well has it been implemented and how well have people been trained on it, and that's a real focus area for us as a business, because we can, some people want to have all the shiny toys, but actually the reality is if they haven't been trained on it or it's not quite the right fit for their business, there's a risk that it's actually going to take their business backwards
totally agree.
And not forwards. So that whole piece around sort of implementation and training is really sort of key for us as well.
Really, really interested in your bit about corporate life, and then you've gone into running a business, which for me, they are two different worlds. What was it? What was the driver personally to make you think?
I think I always had a slight ambition to do my own thing. And when you're in the sort of corporate world, for me, it was quite comfortable. I had a sort of the 9 to 5, very sort of stable income. But it got to a point where my work-life balance was pretty poor. I was commuting up into London at that point, and it was pre-COVID, so it was like 5 days a week, 9 till 5. It was more like 9 till 6 or 7, and by the time you got back, you were back late. So for me, I thought I've got to make some bigger lifestyle decisions here. You know, I had a young family. I wasn't seeing that young family.
Yeah.
So for me, I thought, actually, I need to make a bigger decision here,
Yeah.
step out of that corporate world and then take on my own business. A few other reasons for me was, you know, my father got made redundant in his 50s, which had a real impact on him and an impact on the family. And I thought, actually, I kind of want to be in charge of my own destiny and not have somebody else be in charge of my destiny. So that was also sort of a key area for me. And the other thought as well is, you know, I did some research prior to stepping out, and it was pretty clear that you know, the accounting world at that point was very much based around compliance. It was based around tax. It was about sort of the backward-looking view. You know, so it's very much around keeping companies legally compliant. But there wasn't much in the way of commercial accounting. So actually looking at businesses and going, well, you know, how can the finance team add value here? What can we do to help drive, support this business and help it scale and grow? And so those conversations were, you know, potentially quite new and innovative. So there was
definitely
potentially a gap there in the market as well that we spotted when we set up 10 years ago.
Yeah, really interesting because I think the corporate life. So you know, I remember having done a bit of it my time, and I was going to be an accountant, studying for ACCA, but we would report monthly almost the numbers that went off to Europe.
Yeah,
and it was very much you had within each accounting team. There was so many specialist skills too.
Yeah.
So you then jumping into running your own business, it means you had to be quite aware of lots of different challenges, right? You weren't able to be specialists.
Correct. You know, in that big corporate world, you know, you are a small cog in quite a big corporate machine. And then when you step out of that, all of a sudden everything is on you. You know, and you're seen as being a business owner. You're juggling multiple plates, different priorities. It's exactly the same in the finance world. But what we were always very clear on was our offering to clients to say, right, we can bring you clarity to your decision making because, you know, we're using all of these tools, and these tools implemented right in your business will help you support your business and help your decision making, which should ultimately drive success, reduce risk, and all that sort of thing that you're trying. All small businesses that we're trying to manage. Yeah.
In terms of the sort of customer base you've got, do you work with small companies or all the way? Is there any restrictions or?
Yeah, sweet spot for us tends to be about £500,000 up to the audit thresholds, which get pushing up to sort of 10 million. So it tends to be those.
In terms of turnover,
turnover. Yeah. So that tends to be the sort of companies that where we think we can add most value. Once they get bigger than that, often they have their own sort of dedicated finance teams and larger teams. But when they're of that size, you know, us as providing that virtual finance team can step in quite neatly and sort of bridge that gap. But they might have, you know, say a bookkeeper on board, might have a finance manager, but sometimes they just need more, or sometimes they won't even have that. So we will step in really and provide that, I suppose, whole finance solution. So some of that is making sure the processing is done right, the day-to-day, you know, is done right, that everything is legally compliant. But then equally we can then look at more sort of what we call advisory roles. We're looking at management accounting, we're looking at strategic FD services and CFO advice to really, I suppose, help that business owner or business leader to making the right decisions, because it's a lonely world out there.
Yeah,
right?
it really
You
is,
know, when you're running a business, you know, you do need partners on board and put people around you that, you know, have got your back, that can support you and help you, and that's really what we are looking for. So it's more, you know, accounting is more than just a set of figures. It's about relationships. So once you've got over the sort of technical competence, these people know what they're doing. It's about, you know, do I like him? Do I trust him? You know, and therefore you bring me into the organisation, and then we act as part of your virtual or wider team.
That's definitely how it's worked with us, isn't it? So we have we at the moment have a bookkeeping service done externally. We have someone in house, and then we use it for year end. But also the advisory bit is, for me, is the most useful, because it's that idea that you understand our business, which is which I would say is the most important thing, really. It's not as easy just looking on a spreadsheet and making decisions. You've got to really get down with it and understand what's going on.
Exactly. And I think that's the bit that I personally quite enjoy. It's like the roll your sleeves up. It's sitting around the table with business owners, looking at their businesses for the good and the bad, and there's always good and bad in there. And coming up with like a strategic plan and what we're going to do about it. You know, so that bit's really important to me.
I was at a conference speaking a couple of weeks ago, and one thing that came up, because I talk a lot about really understand your numbers.
Yeah.
So because of my accounting background, I don't feel in fact, I love every time we meet. It's like I can talk to someone about spreadsheets. So it's exciting because most people get very bored in the office me talking about spreadsheets. Yeah. But when we do that, it's a really, for me, it's like a phenomenal way to get right into the detail.
Yeah.
Really understand what's going well, what isn't.
Exactly.
So then to redefine your sort of focus.
Yeah.
So I'm assuming that you might also meet other business owners and businesses where they're not maybe got that interest. How do you sort of help them benefit?
Yeah, exactly that. I mean, it really comes down to priorities of what the business is doing. And as a small business, we're juggling different priorities and multiple priorities. But sometimes we do see it where finances just get pushed down the priorities list. So the business isn't prioritising it. They're not looking at spreadsheets, and therefore they're making decisions on the fly. Really, they're not really understanding the implications of the decisions that they're making, and therefore the risk profile goes up significantly. So what we always try and do is just sort of really distill it down, keep it quite sort of simple, if that's what's needed, and really sort of break it down and say, right, these are the key issues that we can see. This is what the numbers are telling us. Yeah. And then we can start building an action plan around those numbers. And
so in that example, it would be sort of almost simply looking as a business at your main costs and main income, almost. Keep it really simple.
Keeping it really simple, In its simplest form, it's money in and money out. A simple cash flow forecast. I mean, accountants will often try and make it more complicated. Accruals, prepayments, all manner of accounting adjustments, but in its simplest form, it's money in and money out. And if business owners just know that basic and can do it, understand where they are today, and also do a forward-looking view, so a cash flow forecast, then that business owner is already going to be in a lot stronger position than where they are. So that's what we do. We're starting at the basics and then building up to more, I suppose, high-level conversations.
Talk about cash flow forecast. You hear about cash flow is king. It's really important.
Yep.
Cash is king. So why is that? And just give us a bit of a definition of what a cash flow forecast is.
Yeah, I mean, the sad reality, if you look at the statistics of why companies fail, why small businesses fail, and the stats are pretty grim. Most of the root cause comes down to cash flow planning, or the lack of cash flow planning. Often the businesses they can be profitable, they can be doing great sales, so that, all the metrics look or appear right, but actually what they're not close enough to is their cash position and understanding the cash movements in their business. And we see it so often. Predictable things, VAT returns, PAYE, payroll, all of these things that seems obvious to us. Well, we know it's coming. But for getting people to actually look at that, put that down into a cash flow forecast, think, okay, when are all of my big items going to go out of my bank? And if they can document all of those and start to build that framework of a cash flow forecast, then that's going to be really important. So those things going out are often certain. Okay, the thing that's uncertain is the money coming in. Okay, so it's your sales, what our sales are going to be like. It's also when are people going to pay us? Because you can imagine there's a lot of companies that are doing work on payment terms, and therefore, from a cash perspective, they've got the challenge of they've got to find the work, deliver the work, build the work, collect the money. All of those things have to happen to get that cash flow into the business, which is challenging. We work in the real world, but so that's sort of that basic cash flow planning is really important. And to answer your question, why do they go bust? It's quite simple. People just run out of money. They just can't cover their day-to-day commitments, and then you kind of get into a negative spiral. Companies
insolvency sort of territory.
That sort of thing, or they don't pay suppliers. Because they can't afford to pay suppliers, so therefore suppliers get frustrated. And then you get into a whole negative cycle around cash management. And that's when
the temptation at that point, isn't it, is to say, we need some money in, discount, or do something, and that's that spiral of death.
Exactly, and it can drive the wrong behaviours then, because then companies start to become desperate. They start potentially discounting, and then often that is you're on a sort of a drive to the bottom, really, because it's very hard then to come back from that.
We have a quite a large supplier in our industry went under last year. And they were very good at undercutting on hedging and various other things. Right. But the thing is, it was kind of inevitable to look at it, seeing it, the volume and the scale of it. But you can sort of see why that happens, because you're desperately fighting to keep something alive.
Yeah, absolutely. So so I think that's why that planning piece is absolutely key. businesses, just take that time just to look, do that simple cash flow forecast. What does this mean for us? Where are our pressure points? Because there will be cash flow pressure points, but it's just understanding where they're going to come and what you can do. What levers can you pull to try and manage those cash flow pressure points. But so often people don't do that, and therefore, when that VAT bill lands, it's like head in the hands. What am I going to do?
I was going to ask you about VAT, because VAT, there's two. You said a few, but corporation tax is definitely one. Obviously, it's a nice position to be in that you make enough profit, you're doing that.
Yep.
So let's leave that there for a second. But VAT, it's a quarterly payment, isn't it? You normally pay the month.
Most companies are quarterly. You can do it monthly, and certainly for some companies where cash flow is potentially problematic, then we would almost recommend they do it monthly, because then the VAT is settled every month. It avoids the build-up over a quarter, so you've got 3 months to potentially pay. If you're paying it off monthly, it kind of reduces that.
Yeah, so there's an admin piece that you've got to do monthly.
Yeah, so there's an admin overhead. You've got to potentially pay for 3 VAT returns. But from a cash management perspective, it's sometimes easier if you're in that situation, because then the money's just dealt with, the VAT is just dealt with.
It's really useful advice, I wasn't aware of that actually. I've always just paid quarterly. But we save up our money and I hold it almost separately. Yeah. So I'm making a bit of interest on it, but the idea
you've got a good accountant that's telling you to.
I know. Exactly. That's why I'm trying to boost it. But that you did advise on that. That was amazing, and it means that it's a little bit less scary. It's still VAT's going out today, I think. Is it? Yeah. So I'm aware of it. It's this week. Yeah. So that's really useful, that bit of advice. But the best bit of advice was actually around corporation tax. You said to me to pay it in advance.
Yeah, so typically for a small business, so if your profits are below 1.5 million, you pay your corporation tax 9 months after your year end. That's fine, it feels like a long period of time, it is a long period of time, but it does catch up with you, and the risk is you have a good year, you make profit, you generate a large corporation tax bill, and you don't pay your corporation tax straight away, you pay it 9 months later. And at that point, the business might not be quite as strong. Then all of a sudden you've got to pay the tax liability from the previous year 9 months down the line. So that, again, that's where people get caught out. So again, one of the sort of simple bits of advice we often say to people, look, either ring fence it in a separate account, a bank account, so just pay it off in instalments. So with mine, I just pay a monthly amount into a separate bank account. Or you can actually pay it over to HMRC, and they're very happy to take your money early.
They pay good interest rates.
And they pay good interest rates, right? Yeah. So
they do.
They do pay interest on corporation tax paid early. So from a cash planning perspective, it seems to make sense. Pay it in instalments, pay it off early, and also you get an interest payment, interest credit back as well. So again, it's just sort of good practice to try and, I suppose, minimise the impact that tax have on a small business, because when you're looking at those cash flow problems, often tax is one of the areas that gets raised as a big concern.
Yeah, I mean, it's the stress that comes from that, right?
It's the stress. Yeah, exactly that. And that, for small business owners, a lot of what we do is about how do I reduce my stress levels? How do I get in control of my numbers? And so just doing that sort of simple tax planning management is part of that. And also, an area that we look at as well is just making sure that people are set up efficiently for tax as well, because there's certainly things that we can do to make sure that they are being efficient as they can be with their tax and their tax, so they're not overpaying tax, not underpaying tax. We take a view that you want to be set up efficiently, so you pay the right amount of tax.
What other efficient practices are there then?
I mean, that's the other thing is, there's no golden bullet anymore. Successive governments, you've seen it. If tax advisors and accountants are saying, we can save you all of this money on tax and all this sort of stuff, then be a little bit
careful,
sceptical. But there are certain schemes out there, R&D schemes, for example, which still provide tax benefits.
That's where research and development. So that's where you're proving there's a project or something you're doing.
Correct.
Where you would be research and developing for a product or service.
Yeah. So there are those sort of things out there, and for investment companies as well. If you're looking for investment. The EIS scheme and SCIS schemes are out there as well, which provide tax incentives to invest in early stage startup businesses. So so there are schemes out there. So there are ways to be efficient with tax, and just as long as you are using all those ways. But if people are offering you these sort of get rich quick things, whatever,
they're not real.
Just move on.
Totally agree. You're based in Reigate.
That's right. Yeah, so you've got head offices in Reigate. Yeah.
Given that you're, we talked about Zero. It's in the cloud, and you can pretty much do most things on calls.
Yeah.
Do you tend to work all over, or is it are you quite local?
Yeah, I mean, our customer base is fairly varied in terms of type of customers and also location. Personally, I quite like the face-to-face. I'm a little bit old school in that sense. I quite like going out and meeting business owners. You can tell an awful lot about a business just by walking through the door, meeting the people, their demeanour, how relaxed are they, how organised is the office, is there files everywhere, just that whole sort of picture that you build up when you walk into a new business is always quite interesting. So certainly, even if they're a fair distance away, certainly our intro and our onboarding meetings, we will normally do at their offices just to get a feel for them, and also it's a nice way to meet the team and break down barriers as well. But in this day and age, we are a virtual finance team, so we're working with cloud-based systems, so our team can effectively support businesses wherever they are in the UK. And we are only UK based at the moment, we don't do any overseas.
Yeah, because that's a whole other legislation, I assume.
Yeah, it's just, yeah.
In terms of making it, you don't need to add to the complexity.
No, exactly.
Yeah. So it's your finance team, but are you going? I think we've talked before about you've got other ideas to develop that.
Yes. I mean, our basics, we start with the basics. So if we go into a new company, what we're keen to do is make sure that they're doing the basics right first. So and that is, the day-to-day processing, paying bills, making sure the money's coming in on time, making sure the banks are reconciled, just having that nice, neat piece of, bookkeeping that's done, because that's the sort of the bedrock of finance. If that piece is off, if that's not happening, everything else that we do, so management accounts, strategic FD management, all that sort of stuff, is really, really difficult if your core figures aren't right. So the start point is get the basics right. And then what we're looking to do really, I suppose, is more sort of the value add type activity. So then we're looking at their business, we're looking at KPIs. So what should this business be tracking? What would I be tracking if I was running this business? And then we're talking about key performance indicators a bit. So KPIs. These are the sort of the key things that we think you should be tracking based on the other clients that we're working with, and these are working for other clients. So these are the top, say, 5 KPIs. Yeah. And we've got a similar thing in this business, and we've got KPIs that we track each month. So that's sort of the next step, is like making sure that we've got the right metrics in place, and also the right reporting. So we've got some quite sophisticated analytics tools now, which will go in, interrogate the numbers, and then draw conclusions, extract the data and then draw conclusions from that. So it's about using those tools, those analytics tools, and making them, I suppose, understandable, because the risk is sometimes a bit overwhelming. If you go from nothing, all of a sudden you've got all this management info coming in, and you're a bit like, well, what's this actually telling me? And we always sort of say to the team that unless it's driving action or insight, don't publish it. Because otherwise you just, we'll give you a nice, very big pack and you'll go, thanks very much. Yeah. But it's not going to drive action, and really what we should be doing is only providing insight if it's going to change behaviours or drive action in the business. So that's kind of the acid test, if you like, that we do when we're looking at reporting that we're doing for clients.
That's really interesting. We started off with very much doing year ends, and then I got to a point I said to you, Mark, it's feeling too big this for me to be running spreadsheets at night. Can we look into something? And then we used that reporting package you helped us with. And we sat and spent a couple of hours working out what those measures were.
That's right.
So KPI, you're right. That's the term. But in simple terms, it's just us working out what the drivers were in our business. Really. Exactly. For us, footfall is quite important. Not as important now with our online, but it's so there was things we pulled out were really useful.
And it's trying to build that bridge as well between financial metrics, so revenue, profit, cost, and also non-financial metrics.
Yeah, absolutely.
So headcount, website clicks, and this sort of stuff. And what you're trying to do is just build out that sort of quite nice portfolio of information for the client that goes, actually, we're considering financial and non-financial metrics, and the stats are pretty clear. If you combine the two, your decision making will be better because you're looking at a broader range of measures for your business.
It's really, only yesterday we started looking at the spend on our events. So doing Chelsea, doing Goodwood, we did Revival over the last couple of years, and we're trying to sort of map that against sales, which is and things that happen from it. But you're right, there is this sort of third element, which is, do we enjoy doing it?
Yeah.
Do the team enjoy it, and do we meet lots of our existing customers and have great times with them? So you've got to look at all three, really, haven't you?
Yeah. And it's also about sort of tweaking it as well, because you're probably never going to get it right first time. So and just as the business evolves, you're looking at those measures and going, okay, these were right 5 years ago when we set them. Yeah. But is this still what we should be looking at? Or are we doing more events now, and therefore we need to bring in that as a KPI now and consider that? So it's about moving those KPIs on as the business evolves and develops.
So if you're you're meeting up with an SME now, or you're certainly they're listening in. Someone's maybe, I don't know, a team of 5, 6, 7 staff, and they maybe haven't taken their accounting as serious. They maybe just meet once a year with someone, and brush you under the carpet after that. What are the three sort of, I suppose, main things you see that people do wrong?
What they do wrong? Well, firstly, I think is not prioritising their finances and accounting, and not giving it the priority it needs. So they put it down, and that often happens. Therefore, it becomes a once a year conversation with the accountant. The accountant does the books, does the accounts, comes in, tells them this is what you've made, this is the tax to pay, and then you don't see your accountant again for another year. In firms that are going through growth or any sort of real form of change, we would always say you need more than that. You need that forward-looking view, not that backward-looking view in your business. Yeah, brilliant. So, I think that would be sort of the first one around sort of prioritisation. Second one for me, we talked about it already, is cash flow planning. Just be absolutely on top of your cash position, because, as I say, that's where most of the problems in a business will lead to. I think the third area is not understanding finance roles. So, what I mean by that is often, businesses will go, well, we need to do something in finance. We need someone to process the bills and get the money in that. So they'll go out and they'll say hire a bookkeeper into the business, and then the business starts to grow, the business starts to change, and they say, well, actually, we need some more management information now. So then they'll ask the bookkeeper, and the bookkeeper's then producing MI, and then they need a sort of conversation around the strategic direction of the business. What should we do in the decision making type conversations. And it's at that point then you put in a lot of demands on that bookkeeper. So what we often see is companies are not understanding the roles that they've employed people for. Yes. And then the risk then is that the person in that role becomes, well, getting an awful lot put on me. I'm now having to do work which I'm not really potentially skilled in or qualified to do, and therefore there's a risk that they then become under pressure. The other side of that is sometimes people hire too senior resources in business. So I need to sort my finances out, I'll go out and I'm going to hire a finance director. Yeah. Okay, big ticket, and then they're asking that finance director to do some of the more basic stuff, so like processing journals and that sort of stuff, which is, again, you're underutilising their skill set there, and frankly, you're paying a premium for. So, again, it's understanding the roles that sit within finance, and also what you're asking your finance team to do, because quite often when we look at it, we see actually that's why things aren't quite right. You've got a round peg in a square hole sometimes, and therefore you've got to address that and change that.
And as you said, if you're going through a growth period as a business, those changes might come sooner, right? You need to be really on top of making sure you get the right people and navigating that path.
Yeah, and it's getting that right skill set right, getting the right people, personalities in place is really, really important, because if you get your finances right, it's fantastic. But if you get them wrong, it's pretty awful, and it can lead to the worst happening. Your business could fail because you haven't got your basics right. So those, I think, are probably the three sort of key things about things going wrong.
Wicked. Profit and loss, balance sheet, bit of a quick. Come on, give us a bit of what we get when you get to year end, you're looking at it and you're thinking profit and loss is kind of where most people spend most focus. Yeah. But the balance sheet's fairly important, especially if you're looking for like an exit.
Absolutely.
So tell us the balance of those two.
Tell us your balance on your balance sheet. So profit and loss, P&L, that's kind of the mainstay of a set of accounts. And if we're doing an accounts review, we always start with that, because what I'm interested in is how the business has performed. Yeah. Remember, at this point, you're looking backwards. So this is sort of the history. But your P&L is going to tell you how your trade is potentially going. Yeah. And actually, there's a lot of information in that profit and loss, which can add value to your business. So starting off as simplest form would be top line would be revenue, normally how much you've billed in the period. Sometimes that is adjusted, but normally that's how much you build in the period. You've got a comparator, so am I up on last year, am I down on last year? So again, straight away you're getting some KPI, you're getting some measures out here that we can start to talk about, start to think about.
Yeah, absolutely.
Cost of sales or cost of goods sold, really, really important. So how much does it cost you to deliver those sales?
So an example for us, that would be your compost, your pot, anything that goes into getting a plant ready for sale.
And if you're buying a plant and you're reselling that plant, then that's a cost to your business.
Yeah.
And that's a cost of sale. But what that tells us is this is what you're buying for, this is what you're selling for, and therefore this is what the difference is your gross margin. Again, it's a really sort of key measurable metric that we'll be looking at. And if we're looking at profitability, then we're talking to customers about how do you drive that potential profit margin higher? How do you improve the absolute gross margin and also the relative gross margin by the actual percentage? How do you drive that up as well? So P&L, and then underneath that, you've got all your overhead costs as well in your P&L, and just normal due diligence would say you should be going through those costs just to make sure that any potential savings that you can potentially bring to your business. Or equally, you might be thinking, actually, I need to invest more in that. That marketing figure looks too low. I should be putting more into that. So again, those sort of conversations you can be having just by virtue of those numbers in that profit and loss can prompt those type of discussions. And we always sort of look at it as it's not just about trying to hammer your overheads down and get them right. It's all about, well, am I being smart here? Do I need to invest this somewhere else? And it's those types of conversations which are perhaps more useful. Balance sheet, so really that's your net worth of your business. So just to explain it, at the top of a balance sheet you have your assets. At the bottom of your balance sheet, you have your liabilities, and in its simplest form, it's your assets minus your liabilities is what's left is your net worth, effectively.
And we want to grow that, obviously.
The healthier the business, the more assets you've got, then and the fewer liabilities, the higher your balance sheet value. Generally the higher that is, the better for companies. And to your point around sort of sale and exit, if companies are looking at valuations and things like that, then obviously that balance sheet is being really scrutinised. The other key thing on the balance sheet is around the assets that have been purchased in the business. If you're buying assets, so if you're buying, fixtures, fittings, you're developing your site, you want a return on that's an asset, that's an investment. You want a return on that investment. So there's sort of simple metrics as well that we can build, like return on assets, just to see what those returns actually look like in your business. And the other thing you've got on your balance sheet, which is key, is your debt, is your liabilities, who you owe money to. Really, really important. So, if we're looking at a business and those liabilities are creeping up, we're asking the questions why. It might not be a bad thing. They might be saying, well, I took a loan because I've invested in X, Y, and Z. Okay, well, that makes sense. As long as there's a business case behind that investment, we understand what that investment's going to bring to your business, that's fine. But equally, if we're looking at debt and it's just going up and we can't see it actually turning into investments or generating a return, then that could be that's a danger indicator, because now the company is becoming more indebted and that debt has to be serviced. So it's got to pay that loan back, it's got to pay the interest on that debt. So again, that's all coming from your balance sheet. So two sort of very, very basic, and every company in the country should have that. And if you're not getting that from your accountant, that is the basics. So talk to your accountant about that and just ask him to take you through it and just explain those sort of key points to you. And
again, critical, because it's that future planning. Where are you trying to go as an entrepreneur? Last thing then, you took the jump. You run your own business. So there's someone out there listening. They're thinking about it. Should they? And what's your biggest lesson? So should they do it? And what lesson can you share with them?
I mean, without a doubt, it's been the most challenging thing that I've ever done, but equally it's the most rewarding thing that I've ever done, and probably, I don't know if your experience is similar, So in terms of should you do it, well, I would say is, do your planning first. I'm an accountant, I was very cautious in my approach. I think accountants are naturally risk averse. They're not like this, these entrepreneurs that go out, right, we're going to do this, we're going to do that. And I fitted that mold. I wasn't a natural entrepreneur, so I had to sit down and I had to do sort of really careful planning of what I was going to do, how I was going to do it, what it would look like, and also funding as well. Because I stepped out of a corporate role. I had a young family, had the mortgage, and all that sort of stuff. You've got to think about all of that sort of stuff because it's real. Suddenly it becomes very real. But just make sure you're doing your planning and you've got facilities in place to make sure that's covered. And one thing we do see quite often is when we're talking to startup businesses, typically what they do is they fund themselves for the first year, and they assume by year 2 I'll be up and running, I'll be cash positive, and things will be fine. And from my experience, the pressure point is at month 18. So I've got enough cash to get me through the first year. I'm then halfway through my second year, but the second year hasn't quite gone as well as I thought it was going to be. And then month 18 is where the real rubber hits the road, because actually your money's run out because it's supposed to only cover a year. Your business it's going in the right direction, but it hasn't fully got up to where you need it. Yeah. So I always sort of say to people is just watch that month 18. That's your key.
Very good advice. Yeah, James. So we've set up Architect IT with James, and he's coming up to that point.
Is he?
So I'll quickly call him after this. But Mark, thanks so much for coming in.
No problem.
Thank you everyone for watching this episode. You can find it on Spotify or of course YouTube too. Thanks for joining us.
Thank you.
The Plant Hunter Guy podcast.